Hello and welcome to this video on the recent failure of Silicon Valley Bank and the government's intervention to restore confidence in the banking system. In an extraordinary move, the Biden administration has guaranteed that customers of the failed bank will have access to all their money starting Monday. Additionally, the government shut down Signature Bank, a regional bank that was on the brink of collapse. The joint statement by Treasury Secretary Janet Yellen, Federal Reserve Chair Jerome Powell, and Federal Deposit Insurance Corporation Chairman Martin J. Gruenberg ensured that FDIC will make SVB and Signature's customers whole by guaranteeing all deposits, even the uninsured money that customers kept with the failed banks. This move aimed to prevent more bank runs and to help companies that deposited large sums with the banks to continue to make payroll and fund their operations. This intervention has been seen as a significant relief by Wall Street investors, as markets had tumbled more than 3% on Thursday and Friday due to the fear of more bank failures and systemic risk for the tech sector. The investors are also relieved that U.S. taxpayers will not be on the hook for either facility, according to the regulators. However, shareholders and holders of unsecured corporate bonds will not be protected by the regulators' plan. The U.S. banking system remains resilient and on a solid foundation, thanks in large part to reforms that were made after the 2008 financial crisis that ensured better safeguards for the banking industry. The failure of Silicon Valley Bank was caused by its inability to pay customers' deposit withdrawals due to the crumbling value of ultra-low-interest treasury bonds that banks invested in just a couple of years ago, leading to a bank run that triggered the bank's collapse. Other banks with similar profiles to SVB and Signature could be next to fail if customers lose faith that they will have ample cash to fund their deposits. And the tech companies that kept their cash with SVB could collapse if they were unable to make payroll or fund their operations with the $250,000 worth of deposits per account that the FDIC insures.